In this section, we're going to talk about interpreting financial statements. A company's financial statements need to be put into context. U.S. security laws require that publicly traded corporations in the U.S. have an audit done by an independent CPA firm, which is an accounting firm that specializes in providing public accounting services. And they will perform this audit of the financial statements. And it's important that CPA firms perform audits with integrity, and they must be independent of the firms they audit to avoid that conflict of interest. Annual reports often include many pages of notes, and these notes disclose additional information about the firm's operations. They also disclose information about accounting practices and special circumstances that will clarify and supplement the numbers that are reported on the financial statement. These notes might also provide details about the way the firm funds its pension or health insurance for its employees. They might disclose changes in accounting methods that would affect the comparability of the current financial statement with previous years. These notes might also disclose important facts about the status of a lawsuit against the firm, for example, or other risks the firm might face. Stockholders who ignore or stakeholders who ignore these notes are likely to miss out on important information. Another section that's important is called Management's Discussion and Analysis, and this is where top management team provides its take on the company's financial condition. Horizontal analysis is the practice of using comparative statements to identify changes in key account values through time, and a lot of times these are compared from previous periods or previous years to look for trends. Some of these trends might be increases or decreases in revenues or expenses, or what happened to key assets and liabilities through several time periods. The next section is on budgeting. This process facilitates planning by requiring managers to take goals and put them into measurable quantities and identify the specific resources needed to achieve those goals. So this is a management tool, and it's showing what resources the firm will acquire and how they will use these resources. Here are some advantages of budgeting. You can look over these. I'm not going to read these out, but make sure that you read the advantages. And there are two approaches to the budgeting: the top-down budgeting or the bottom-up budgeting. The bottom-up budgeting is more common than the top-down. Top-down budgeting is the key here is top management prepares the budget, and they really don't get much input from middle and supervisory managers. So top is preparing it, bottom up. The middle and supervisory managers are allowed to actively participate in creating the budget. Now, any overstatement of needs or low budget goals are going to create what's called budgetary slack. Now, I want to talk about the different budget components. And I am going to show you the visual because it'll be easier to see and understand. So the master budget is everything you see here. So the first step is preparing the operating budget, and the way you start that is the sales budget. Next, the production budget is developed, and this is used to prepare your direct labor costs and your manufacturing overhead. also your direct materials. The last step in preparing your operating budget is the creation of the budgeted income statement. And we also have to prepare the selling and administrative expenses budget because that is going to go on your budgeted income statement. And then two main financial budgets are, if you look here, the cash budget. And this is going to show short-term fluctuation in cash flows, or it's going to identify those anyway. And then the capital expenditure budget is going to identify the firm's planned investments in fixed assets, like if they're buying new fixed assets, it would have to be in the budget. And then the budget's balance sheet is going to be prepared after taking these two items. You're going to be able to prepare the budgeted balance sheet. And then the master budget is going to show how all of these pieces fit together. Static budgets are excellent tools for planning, but they do have weaknesses, especially when they're used to measure progress, evaluate performance, and identify problem areas that need correcting. This last section that we're going to look at is Inside Intelligence, the role of managerial accounting. So at Holmes, if you take an accounting course, managerial accounting will be the second accounting course. Managerial, or also known as management accounting, is designed to meet the needs of the firm's managers. So now we're looking at it. We were looking at it from the financial standpoint, which is going to be the people that use the company's information to make decisions. And these could be external users, whereas managerial accounting is just going to be used by the internal users. So here you can see what I was saying here. And this shows the way that managerial accounting differs from financial accounting in terms of its purpose. So internal here and external here as far as users. And financial accounting has to follow GAAP and managerial does not. And then it shows how the types of information presented. So it's not just looking at the financial information, it's looking at financial and non-financial. So you can read over the differences there. And then this one is the same. Now we're looking at the timing. And then you see GAAP here for financial, and they don't have to follow GAAP for managerial. And then you can see the time periods. I'm not going to go over all that, but I do want you to kind of look at it and see the differences on your own. Now, when you're talking about managerial, we look at a lot of cost, and these are the value of what is given up in exchange for something else. Some of the examples of out-of-pocket costs would be the wages a company pays to workers and the payments it makes to suppliers for raw materials. Some of the examples of fixed costs would include interest on a bank loan and property insurance premiums. And some of the examples of variable costs are payments made for many types of labor, supplies, and utilities. So fixed costs remain the same within a given level of production, and variable costs vary directly with the level of production. You have direct costs, indirect costs, and ABC costing terms here. Direct costs are going to be costs that are traced directly to the production of the product. An example of a direct cost would be wage payments made to workers that are directly involved in producing a good or a service. Some examples of indirect costs are costs that a firm incur for plant maintenance or depreciation on office equipment. It's easier to measure and assign direct costs than it is indirect costs. One of the methods that managerial accountants have developed to allocate costs is activity-based costing. And this is where you assign product costs based on links between activities that drive cost and the production of specific products. This is called activity-based costing. So here is the self-assessment, and I want you to reflect on this, think about it, answer these questions, and then let me know if you have any questions about Chapter 8.